Hello, everyone. Mike Arnold here, co-founder of Path Trading Partners with the soon-to-be-on Bob Iacchino. It's been forever since we've had Bob on. It seems that way. Bob is still thawing out from his trip in Chicago, but you'll be glad to know he's back in Florida, all warmed up. So that's all good. Well, I haven't said it in a few days. If you're new here, please do consider subscribing, ringing that bell, and hitting the like button. All right. All right, we'll get right to it in a second. Good afternoon, Patrick. I don't know how you do it, Patrick. Generally, first one in, you win. You win the prize. You're just the honorary first one in. You got Satan, not Santa. It's only one day into it. Although the NASDAQ take it in the shorts. The Dow actually closed up today. Good afternoon, PTP. Jacob with the spelling. Hello, Josh. Don't fight the market internals. Very good. Very good message there. I was going to say top of the morning, but it's top of the afternoon. Good day, CD. Busiest week in the car business. Sorry for the lackluster Twitter posting. We'll be back to normal next week. Hey, that's understood, Sterling. Thanks for all you do. I hope you sell a tremendous amount of cars. All right, real quick. The only other thing that came out after the live stream that was important, Dallas Fed Manufacturing Index coming in at minus 18.8, way lower than forecast. And if you read parts of the report, it was ugly. Ugly. So, there you go for the tipping into the recession reinforced by the Dallas Fed Manufacturing Index. Tomorrow we have some mortgage stuff, pending home sales, Red Book, 5 minutes before the live stream. I'll keep watching. Remember, we have some regional Fed indices this week that I'm paying attention to. We got the Richmond tomorrow and the Dallas Services. Dallas Services is more important than Richmond Fed, but very going to be interesting with that. So, but very minor things tomorrow. Very minor. Market map. Mega caps taking the shorts. Tesla just getting obliterated. Looked like a lot of forced liquidation today. Forced liquidation in Tesla. And since I put up the Tesla headline, this will probably mark a short-term bottom coming in soon. So, it's like, hey, you got the Path Trading Partner headline index. Technology getting blistered and comm services getting blistered on the way down. Energy holding up pretty well today. Fed Watch Tool, 63% for the 25 basis hike. And fear and greed still in fear mode. With that, and without further ado, let me bring on Bob Iacchino. All right. Let me just say hi to Nas Industry. Hello.
What's up, guys?
All right, Bob. What's going on? y'all warmed up. Tell them about your weather experience in Chicago. How much you loved it. You're going to move back here.
Yeah, no, that's not happening. That was so brutal. And literally, the one night we have a parking pass at my mom's place where we stayed. Went to the parking lot. It was a minute and a half walk, and I came back with the front of my thighs on fire, like literally in jeans. The wind was cutting through. I checked the wind chill. It's negative 37. I had a hat on. I had gloves on. I had a North Face shell with a thermal shirt and a coat. Couldn't protect my legs unless I had long underwear, which I didn't have. It was literally hours before I could get the front of my thighs warmed up from a 1.5 minute walk. Sucked ass. It was brutal, and I will never live there again. I will visit it every single year, but I will never live there again. Awful.
What's the temperature down there?
Actually, today, so when I got back here, it was 40. So the person who picked us up was like, keep your coats on. It's not warm here. But I just went for a bike ride and short a T-shirt prior to this live stream. So, I mean, right now we're sitting at, let me get the most recent, 69 degrees. It was 72 earlier. So it's a beautiful thing.
Yeah. All right. We're moving.
You should all move.
Oh boy, everybody just bail on Chicago. So, what's your take? We haven't seen you since last Tuesday.
Mhm.
had a fair amount of back and forth market action, but let's see. On Tuesday, we closed in the S&P at 3849.25. Today, we closed at 3856. So we're technically 7 points higher than when we closed from last time speaking to Bob. Bull market.
Yeah, yeah. Technically, I'm still in that position. I mean, obviously, we all know where my stop is now. It's break even. It should be about 36.40, which is below the 200 week moving average, which is now at about 36.60 or 36.62,
It's the
somewhere in there.
3666. It's see
66. Okay, fair enough. Um, we got a double cross on the daily. It certainly looks weak, but the end of the fourth quarter is coming. Santa Claus Rally, for those of you that don't know, is technically would have started today. It doesn't have to be up today, but the measuring point would be today through about January 2nd or so, if you're looking at it just from a historical perspective of what's been called the Santa Claus Rally. I thought the U.S. house price index was interesting. It's not a very widely watched piece of data, but I think it's an important one because people feel wealthy when their homes are priced higher. Just looked at the area here, the sort of southwest Florida area. I live in a fairly affluent area. If you were to stretch the boundaries out, I don't necessarily live in an affluent development. I live in a mixed development, but year over year, housing prices up 2.3%, almost 300 places for sale, only 77 have sold. Housing is falling off. It's rolling down a hill. I wouldn't say it's falling off a cliff. Florida, obviously, being one of the biggest benefactors of the COVID exodus from places that are as cold as Chicago for other reasons than the cold. The last 9 data points for the month over month house price index, we had the peak. Then we had 6 consecutive readings that were lower than the previous month, 1 uptick, and that was last month's 0.1% increase. And then, of course, today, which was unchanged. So is that stabilization? I don't know. We're looking at 8 consecutive months lower in the year-over-year rating nationally. So housing is awful, and people feel richer with their housing. Tomorrow we get mortgage applications and year-over-year pending home sales. So, Mike, I don't even you know this, but actually, I'm going to tell you this privately, Mike, and I'll basically tell you guys that some of the new homes that have been already purchased and theoretically contracted, people are defaulting on now because of the mortgage rates. Mike, I don't remember if I told you something on a personal note or not, but people are defaulting on homes they're supposed to be closing on right now because of mortgage rates. And because of that, some of these homes are being sold at deep, deep discounts from where they were sold. Now, that doesn't mean that's a deep discount from a year ago or 2 years ago, but it means it's a deep discount from, I don't know, let's say anywhere from 8 to 16 months ago, depending on how long it would have taken to complete a house during a supply chain problem. So yeah, that's going on with housing. So the housing thing interests me a lot because I think it's part of what is going to drive the end of the first quarter sell-off that I think is coming. And this could be the beginning of it. It could be, but given the low liquidity nature and the desire for people to have a Santa Claus rally, I'm not going to count it yet. Now, if you listen to what's the phrase I'm trying to think of, Mike? Everybody now believes we're going to sell off in the end of the first quarter, the beginning of the second quarter. Actually, most people think the first quarter is going to be really bad. So I never liked that. And I think I might have said this the last time I was on. I never like when I'm in with that large of a consensus. But I also don't see a way out. And I suspect the way out, the way that all those shorts would get stopped out, would be a massive Fed pivot in terms of interest rates to the point where they begin quantitative easing on a small scale again and possibly aren't truthful about holding rates lower or higher for longer. I'm not predicting that. I just think that could be one of the reasons why the sort of consensus could get stopped out, in which case I still would be of the idea that the lows for the bear market are not in, because I don't think that type of a flip could take us up to new all-time highs. I don't. I just think the economy has such a poor future ahead of it. But we'll see. That's a developing opinion.
Well, it was very low volume today on this
Yeah.
minor pullback. Rates, though, rates, hey, we've had a pretty rapid steeping of the yield curve also. The 10s, 2s back to only minus 53 area.
Yeah. Yeah.
And the 10-year, so that's a pretty steepening over the last week, 2 weeks. And the 10-year.
And while you're at it, Mike, while you're at it, go over what your research showed you about equities while it's coming out of the inversion like this.
Well, that's when equities generally take the biggest dump, especially with acceleration towards zero and then above zero. You could really start looking above zero to a point about 0.25. It can go on a little longer than that. But so if this keeps accelerating, let me get back to the 10-2s. Really, that's when you get the major market meltdown from inversions. So we've started a pretty decent bounce. It's nowhere. I mean, we're only back to where it was trading at the beginning of November. But we have had, I mean, if you look at this on the monthly chart, that's 4 straight up weeks so far this week not being over yet, and finally another return to the rotation zone. I will get really interested once we start getting a weekly close above the rotation zone, especially if we get the weekly close back into this consolidation from August to October before the last little push lower, because then that could have completed the decline, and then I will really start watching for some more of the sell-off. By the way, on the 10-year, anybody was trading the yield with that really nice double bottom today finished the pattern. Beautiful trade there. Again, not everyone works, as testament by the NASDAQ, which triggered a 4-hour double last night, coming back and just, boop, stopped, trade done, over. That's why nothing, and then back to the 87.5% harmonic. So everything does not work, but you put the probabilities in your favor, and when you have a loss, you take your loss. Right?
That's it. Put everything in your favor and stick to what you decided was the correct path for that trade.
Correct. So you do not average down like a lot of Tesla people were doing on this whole thing, and it looks like, man, forced liquidations. Have you looked at the Tesla chart?
The Tesla chart?
Yeah.
You broke up there. If you're saying the Tesla chart, yes. And I started to think that this is a Chipotle situation where I kind of want to buy it, but I got to wait until Mike tells me it's okay to buy it.
Well, anything now, I'm expecting some kind of bounce play that everybody will say, see, it's all back to normal, and then we'll get the next gut-wrenching rollover. But way below look at where even the 200 and the declining rotation zone is on the weekly now. Even a bounce back to 163 just takes it to major resistance for another rollover play. It did hit, I'm considering, even though it's 107.62, we hit another harmonic in here at that 75% at 112. I'm considering, from a stop lowering perspective, the very sloppy head and shoulders, which we've had on this for a long time, but that triggered back on a week of October 10th. And it's the end of the year and it already hit the first target. So that's chugging along nicely, but it's a stop reduction at this point. Now, and all
It's
the people,
interesting, Mike, because that's a weekly death cross, right? That you had there on the Tesla chart. But my research on the death cross shows that after you get a cross and that initial sell-off from the triggering of the cross, you get a rally up to the cross. And then the exact move, or the extended move, is that it comes after that. Now, it's not 100% of the time, but that would make sense compared to what you just said.
Yeah, and then the next target with the head and shoulders, and the probabilities that shifted back at the beginning of December that we should test 62.55 to about 52 over the next few months. Did not think we'd get this quick to the first target, though.
Yeah, same.
But hey, it will literally look today for people trading Tesla. There are some gaps left behind them. This was getting into what was looked like forced selling on the tape. So, what else? What are your thoughts on crude, Bob? Crude. China reopening, sort of, but who, with the
And
lifting
not
all the
only that,
COVID stuff, crude back to the
not
50
only that,
day.
well, not only that, but so AAA had a survey a day or so ago. And basically, we're back. We're very close to what AAA's estimates, and having been in the airports, I can confirm anecdotally their estimates that this holiday season is close to pre-pandemic levels in travel. Now, that's including massive weather disruption. So there could have been people who saw, I mean, I could have canceled the trip to Chicago. If it wasn't my mom's 80th birthday, I might have. I mean, I knew the weather that was coming, right? My mom had her 80th birthday, and that's why we went so early. So we got there a day before the weather, and we came back a day before the delays. So we literally hit a perfect niche. But if it was my mom's 78th or 81st, I'd been like, Mom, we'll come visit you in April. By the way, Patrick Gusto, I'm never coming to Minnesota in February. But looking at it from this perspective, AAA said over 112 million Americans are journeying 50 miles or more from their homes from the 23rd of December to January 2nd. That's a 3.6 million traveler increase from 2021. And if their estimates are true through January 2nd, it'd be the third biggest season for holiday travel since 2000. So it's not just China, even though China was what spiked it to the highs, right? We saw it in copper as well, Mikey. You saw copper spike on the China news and then come off on yields in the US dollar. We saw a similar dynamic with crude. Crude actually, I thought crude was going to settle above 80. Yeah, look at that copper spike. That's 2 days in a row where the low represents a gap up from the previous day's settlement, right? We didn't even get to the previous day's settlement. That's 2 sessions in a row in copper. Okay. Now in crude oil, we didn't necessarily have a gap up, but we had an early off of China. And then the dollar started to strengthen as yields continue to kind of tick up. And that took away a little bit of the steam. But crude did finish mildly higher. I thought it was going to finish above 80. If it did finish above 80, or if it does tomorrow, it'll be the first time since December 2nd. So these are short-term breakouts. I mean, I've said before that, my new thing is $95 for crude oil for WTI. So we'll see if it gets there. That's just sort of based on supply and demand, and the price caps aren't working.
Well, where's the 200? The 200's at 95 right now on the daily.
Oh, there you go.
Hey, options 22. Anything else? Gold up today. Gold, a nice little spike up. No potential horribly sloppy double is now invalidated, but gold holding up real well. Any other thoughts on anything metal related? You sort of touched on copper.
Yeah, touched on copper. I mean, copper's probably got some upside left to it. And obviously didn't love the price action today, but if yields continue to go higher here in the U.S., that'll be a headwind to all of the metals. The interesting part to me is gold. I still believe that gold. Okay, so if yields continue to go higher, so a theory right now, if yields continue to go higher, the dollar strengthens off of that, doesn't necessarily strengthen, strengthens a little bit, okay, off of that. That's going to drive risk assets, meaning equity markets, lower, and gold might actually fend that off because it's likely to mean that the Fed is going to. So I don't know if I said it in here, Mike, but I know I said it on TV, is that the new thesis I'm working on now is the Fed just accepts a higher inflation rate. And they may announce it. They likely will not. They'll just accept inflation around 4.5% rather than deal with the recession that they're already driving us to. Now, we don't have, if you look at wages haven't begun to come off yet. Jobs numbers are not horrendous yet. Last week, we had the first downtick in continuing jobless claims in 9 weeks. First one. So I don't necessarily think that that the Fed's in a spot where they have to feel that way yet. But it's coming, right? I mean, it's definitely coming. One of the things that was out there, we were talking about tech layoffs, right? Tech layoffs. There was a story today in Bloomberg that said a lot of the tech layoff people are getting jobs within 3 months. So no dramatic loss of jobs yet. So people looking for the Fed to pivot, I'm not sure why they would pivot if things are still strong, right? So if and when they do, though, gold takes advantage of that. I think there's a sort of undercurrent of gold strength, regardless of what the dollar does, as long as the dollar doesn't resume the strength that it had as we were getting into the 75 basis point rate hikes. And I don't think it will, as long as they stay in the 25 basis point range, which is what I think they'll do in February.
All right. So all right, back to the dollar. So what are you watching for more dollar strengthening?
No, not anything dramatic, mild dollar strength based off of yields, but I don't think it's going to be dramatic. Right now, basically, if you look at it from this perspective, our Fed is tapering off their rate hikes. ECB and BO and UK and those, they're not. The Bank of Japan just joined the party with a little bit of a lift of their JGB cap. So the Fed has led the charge up. You could argue the Bank of Canada led it, but still, the Fed led the charge to higher rates, and now they lead the charge to lower rates, and that's going to be a headwind to the dollar. So, no, I don't see a dramatically stronger dollar at this point.
All right. Anything else you want to touch on?
No, I mean, it's a quiet week. This is a very quiet week, which is part of the reason that we get these Santa Claus rallies more often than not, is because the volume is low and you get this sort of traditional, typical upward bias in equities, and it continues. So we shall see, my friend.
All right. Back on Thursday?
Back on Thursday. I'll be here.
Okay. So we'll get more thoughts in a couple more days from Bob going in the year end. And then next time you'll be on, it'll be a brand new year.
Yeah, it will be. That's exciting.
2023.
One of the worst years in the equity market since 2008. It's nice to be in the front of that.
Okay. Well, Bob, are you still in your long position, though?
I am, yes.
Sorry, I just had to get that in at the very end. CD says, thanks, Bob. Sterling says, thank you. Again, you have a wonderful... Hope you get some extra rest this week. Enjoy the 70-degree weather, and we will see you on Thursday.
It'll be 82 on Saturday.
Oh,
I'll see you guys later.
All right. See ya. Oh, you did not give me that information, so let me know.
Hey, guy, can I just throw something out there?
Sure.
At Shy Girl on Twitter, Tracy Schuchart, who was on our podcast a couple of weeks back, just tweeted, CNBC just said higher yields are weighing on tech. Where were these geniuses months ago? I love that the shine is coming off the CNBC rose. Just makes me
I'm
happy.
so tired of that. I'm hoping the shine's going to come off a lot of media because most of it's garbage.
All right. See you guys.
All right. Bye. Hey, I'm back. There. Oh, now I got to keep adjusting. I got to fix this camera stuff. There we go. All right. Hey, Sterling. So, yeah, the Tesla PE is still 38.3, GM 5.74, Ford 5.14, Chrysler 277, Toyota the highest of the bunch, 928. Besides, I think Ferrari's got a higher PE also. But that would Tesla would be trading 33.41 if it was with the same PE as Toyota. But remember, Tesla's not a car company. It's whatever people want it to be company. So, yeah, Tesla's... And remember also, if we get earnings compression because they're willing to take less margin And if their deliveries start slowing down, you start getting the earnings compression on Tesla. It could go, not just, I better stop there because it's just really frustrating to when the Tesla groupies come out of the woodwork that told me it would never even come back to this kind of pricing. And this is why, and I'm not picking on Tesla with there, I am tired of a lot of people saying all you do is dollar cost average until it turns around. You don't. Unless you've mapped out what I call trading around a core position ahead of time, you don't just dollar cost average. Because what happens when you can't afford the next leg down, or you have to put up the extra money for margin so you can't dollar cost average to avoid liquidation? You can't. So, dollar cost averaging is not a good solution, especially with high flyer stocks that have turned around. I don't think it's a good solution unless you've mapped out a very good strategy in what I call trading around a core position, where you said, okay, I'm going to allocate like 5 tranches or something, or 10 tranches, but I know my maximum capital commitment and I'm going to wait for extended pullbacks, and then it's called trading around a core position, which also means you're not hodling. Look at ARK. Look at ARK. Oh boy. Oh boy. There's finally some outflows in ARK. I mean, geez, trading now back at 17 levels. Could you imagine round tripping this whole thing? Oh, hey, Rich. All right, so where do we sit? As I popped up on the screen a little earlier, but just the volume today, very, very low volume. Very low volume, not quite as low as the Friday after Thanksgiving, but you exclude that, we're the second lowest compared to that. So yes, it did sell off today in the S&P and Nasdaq, but the Dow still holding up rather nicely. The Dow eking out a positive close so far. It is closed, so Dow eking out the positive close. Dow could still trigger this double bottom. Completely valid. That's what I'm paying the most attention to. As I said this morning, from any bullish perspective, I'm watching the Dow the most. Oops. I'm watching the Dow the most. So let's just get to some key levels. Let's get to some key levels. So I just flipped the harmonics today to see. I was watching this 50% pullback. Let me change the color here. Let me change the color. And you can see right here. That wasn't the right one. All right, you can see right here. You can see that 50% pullback. Is this a valid, before I get asked, is it a valid double bottom? Yes, it is. So, do we have a potentially bullish play for tomorrow? And you can't let recency bias fake you out. You can't say, well, oh boy, the double last night in the NASDAQ got stopped out, so I'm not trading any doubles during Santa Week. Doesn't work that way. So, where would that double potentially take us? First, you'd need a close above 38.62 on at least a 1-hour basis. In these markets, the way I vet things out, I like the higher time frame closes. But that's where it is, and then that could take us back to the highs from last Tuesday, all the way back to 3,900. So that's the minor bullish pattern. Is the bigger bullish pattern stopped at or not, which is not triggered? Is it off the table yet? No, it is not off the table. Today's price action did not invalidate the bigger double. So we still have a new potential minor bullish setup and the other bullish setup in place. Key levels I am watching on any pullback, this 38.44 area and then 38.30 are my two levels. We get a close below 38.30, then that triggers me Then I'll start watching for a move back to 3,800. In our NASDAQ, which the double did get stopped, you can see here rotation zone just heading down. There is no great play unless, for me, if we break down below Thursday the 22nd's low, I am targeting 10,717 to 10,742 area. Pretty rapidly, we could see a rapid sell-off. So that's my thing there. On any rally, you can see tech taking it in the shorts. We don't have any. Remember, we had the double stopped. The only thing I am paying attention to, we got the gap fill from the overnight gap last night when futures reopened. I'm pretty much just using these harmonics to the upside. My overnight will be 11,000, then 11,065, then 11,130. I'm really focused to see how we do on those lows. Gordon Johnson was filed for being a mega bear on Tesla. He might get his job back now. Well, he has his own company. So, but it sometimes takes time. Timing is very hard on these things that are emotional stocks. And it went longer and farther than I even thought it would to the upside. But now it'll go longer and farther back to the downside. Thanks for putting that out there. Options. Could sector rotation leaving tech and junk be the cause of a stronger Dow? Yes, you have a Dow is more of a flight to safety of the stalwart blue chips. So that's why it is holding up better. The S&P really didn't have much damage done. It was only off 38 basis points today. I mean, the big news today was the NASDAQ. But this is showing you the things that have these stronger patterns are holding up better. That's why if we trigger one of these, my main go-to is the Dow. What else do we have? We already talked about notes coming back down, not yet quite back to my target, 112.03. But then between 112.03 and 111.09, we'll watch for a potential bottoming formation. Dollar index, I pulled it off while Bob was at the double is now invalidated. If we do get a move above the rotation zone on the daily, which is about 104.65, that's the level I'm watching now. I will be utilizing a return to about the 200 as a target. Euro, not much going on there. A little rotation back up, but so far very, very weak in the euro. Pound, just drifting, but not much going on in the currencies today. Bitcoin, a little sell-off. Bitcoin still more trading in conjunction with the NASDAQ than anything else. So let's take a look. We already looked at Tesla. We don't need to look at that anymore. Again, I am watching for this looked like a lot of forced liquidation. So at some point, I'm watching for a bounce play. Have to be very nimble because when it turns again, it will turn. And I'm expecting all the people, once this gets back to like 120s, 130s, everybody say, see, the lows are in. And anybody who has cash left will rush in to buy it. And then the next one will just be brutal when it turns lower again. Apple, lowest daily close since June 16th. And this almost eked out a lower close, but not quite. So Apple flirting with disaster. By the way, the potential double is still in play. That's the only mega cap that's really got anything truly bullish. Microsoft, again, some of these, they looked worse than they are, but Microsoft, another very low close. What I'm going to be focused on now with the next breakdown to Microsoft is this gap fill back from November 22nd. However, on any rally, I'm just watching for a turn into prior support becoming resistance in the daily rotation zone. Stuff just not The mega cap's not looking healthy at all. Amazon, another recent low close. I mean, Amazon just getting obliterated. I'm still expecting much lower prices, but Amazon now closing back below. I think this is the lowest since March of 20. Brutal. What else do we have? Then I'll look at comments again, and then we'll keep it short because it's holiday week. Google inside day. Again, some of these mega caps, it looked a little worse than it truly was, but any rally in Google looking for the next rollover play. Yes, if you're wondering, this is a potential valid double bottom. Do not think it will trigger, but we got to map it out from the point of completeness. It is potentially there, way off. What else do we have? I think that's about it. Let's see. Have we already done the SPY? I was going to just do the SPY tomorrow morning, but we can look at it. Nothing's really changed. Nothing's really changed. Inside, nearly an inside day. Technically not. I shouldn't have said that because it actually eked out a slight higher high than Friday. But I'll just be watching this. There's a very key area to pay attention to now for the spiders. I'm going to ratchet this down. Tomorrow, here's my key area. Why? About 383.15. Why? You have the virtually the gap open from Wednesday the 21st. A reversal gap open to the 22nd to that same level. The high area from last Friday and the high area from today. We break above that, you could get a pretty quick move higher. That's something I'm paying attention to. And you break above this level, you see it right here, you got the gap fill. So that's the key area I'm watching for the bullish setup. And nothing today, even though we got the close on Friday above the 62.5, nothing today changed the probabilities with that. And you get that break above this level. Look, the breakdown zones and the gap fills right around the 87.5. So that's the play I'm watching close, though. Closest between the spiders and the Qs. If you're looking to play an index separate from the diamonds, because the diamonds, again, are the Dow, and we don't cover that a lot. And this is not a double on the diamonds on the Dow on the 1 hour. You still do have the diamonds. So if you're looking for a separate, bigger play, keep an eye. If you only play the stock ETFs or something, keep an eye from the bullish if this does trigger on the diamonds, especially with the rotation into the Dow, again, holding up the best. Up 12 basis points today when everything else was down in this country. The DAX was up 30 basis points. But that could be your little play. Other than that, the second greatest play I'm watching is the spiders. You want a fantastic, not triggered yet. And it's not just a 5-minute close unless a 5-minute close with momentum, but I will watch for a close. If we don't get momentum for a retest, this area holds there could be a nice little upside, and that could be with a tight stop. Again, can't give specific trading advice, but that is something massive on my radar screen. So my two things, the diamonds for that little double bottom, not double in price. I have to clarify all these things, especially this day and age. You know, with Kathy Woods, if you invest in ARK, it'll double. Oh, you have to be specific. No, that would be a little double bottom play in the Dow or that gap fill play in the spiders. The Qs, you now have a multi-bottom in here. There is no fantastic gap play. Now, we start breaking down. I said in the NASDAQ, we start breaking down the Qs below about 262.40. My key target, Minor is 260.91. Major target 259. So on a market weakness breakdown play, the first thing is the Qs / the NASDAQ if you trade the futures. That's the one I'm going to for the breakdown play. The break up plays are the spiders and the diamonds. That should map out a roadmap. Okay? Hope that helps. Will the Fed minutes on January 4th be a catalyst for upside to the SPY? You already got the January effect coming out then. It could just amplify it. But we'll have to see because a January effect isn't guaranteed also. Hey, George, Tesla going down parabolic, which is why now we're getting to nothing goes down forever. Although if Elon gets margin calls, it could get interesting. Yeah, Amazon still has a PE of 78.28, and with their web services or cloud stuff starting, businesses are going to be dialing back next year. Amazon's going to come down. That's why. Now, the only thing that would change that is something that Bob talked about. If the Fed did do a pivot earlier, or said came out with language, hey, we're going to pause and then we're might be easing quicker, then you could see something change. But beyond a snap rally off of that, I don't see it just yet. All right, with that, I'm going to wrap it up for now. Hope you have sort of a roadmap mapped out for the next couple days. I certainly do with what I just covered. And we will touch base tomorrow morning. Again, very, very quiet economic calendar tomorrow. If you tuned in late, very quiet. Not much besides the Dow. The biggest thing will be the Dallas Fed Services Index at 9:30 Central. Richmond Fed Services Minor at 9 a.m., but you have a very light day. Thursdays gets a little busier with initial and continuing jobless claims. And then Friday, besides your Chicago PMI, which was a horrible print last month, it's a quiet week. So just don't get chopped up. If we do have some patterns trigger, some bullish patterns, they're definitely playable. But, enjoy the holiday week. You are welcome, Charles. You are welcome, CD. With that, I shall talk to everyone tomorrow morning. Bye for now.